So today we're going to talk about FHA loans, the ins, the outs, the requirements, and what does it take to qualify for one. I think you'll be surprised at what those are.
FHA stands for the Federal Housing Authority. It was a loan that was created back in 1934 by the federal government, by the Federal Housing Authority, to help people get into houses. They're dynamite program. My first house I ever owned, I used an FHA loan to buy.
My first home, FHA too.
Yeah. You know, they're sometimes considered a first-time home buyer loan. They're not that. They are a loan that allows for, I would call it gray area, maybe some credit challenging, maybe a lower down payment.
They widen the range. I mean, the reality was that before 1934, right? Most people, if you got a mortgage, you fit inside that conventional box.
Well, back
right?
in 1934, you're putting down 50%.
Yeah, so if you fit the mold, you got the loan. Not enough people were buying homes. The government said that, hey, we got to do something to help the normal person obtain the American dream, which was like buy a house. And so really FHA loans expand that qualification criteria, and they do so in so many dynamic ways that for the most part, it allows most people to find an avenue to home ownership.
Yeah. So let's talk a little bit about some of the general guidelines around FHA. First off, FHA is going to require a 3.5% down payment. You can put down more if you want to, but the minimum requirement is going to be a 3.5% down payment. Now, those down payment funds, they can come from your funds, they can come from a gift from a family member, or you can utilize what's called a down payment assistance program. So 3.5% down is going to be your required down payment. Your credit score is going to be kind of, your minimum required credit score can be as low as a 580. People with great credit can still utilize FHA if it makes sense. At the 580 range, it gets a little trickier, but there are certain things that we can do to see if we can get you approved. The general things to think about with FHA are going to be when it comes to underwriting. Essentially, when we submit a file, the first step that happens is we issue what's called an automated approval. An automated approval is us putting the file through an automated underwriting system created by Fannie Mae or Freddie Mac. And that will tell us the ins and outs of yes, it likes it, or no, it doesn't. If it comes back and says no, we have the ability to do what's called a manual underwrite, which basically means a human being gets to look at it. An underwriter actually gets to use their skill set and their history to make the decision.
And it's really valuable, honestly, because so often, if you didn't fit inside that box, FHA is really your only chance to have the path to home ownership, right? So we say the same thing, like facts tell, but stories sell. And FHA is a special place where we have the opportunity to do manual underwrites to help folks that have peculiar situations that are clearly, if a real human was looking at the deal, it would be a totally slam dunk.
Yeah. I call it storybook lending. If something's wrong in the past on the credit, if we have a good reason for what occurred and we can write a letter explaining what happened, what we did to fix it, and then how that fix is going to ensure that something doesn't happen in the future, we can usually get it done. For example, let's say that you, the borrower, fell off your roof and you broke your leg, okay? And you couldn't work for 6 months. And because of not being able to work, you lost out on income for 6 months and then fell behind on some bills, and then you fell behind on some credit, and everything got a little bit tricky. And it shows up on your credit report, and now your credit score is suffering, and you've got a 610 credit score. Well, the underwriter might ask, hey, why were there some late payments on this credit report? If we can write a letter and then document, hey, borrower fell off his roof, he broke his leg, here's the doctor's records, he is now back to work full time, here's a letter from his employer saying he's back to work, and we're able to show that he hasn't been late since that occurrence, that's a pretty good way of getting it through a manual underwrite. It allows for flexibility. It's more of a gray area and more of a bigger picture, and allows for just general life stuff that happens.
Closing costs with an FHA loan are also unique. There's some additional fees that you're going to see every single time you close an FHA loan compared to a more traditional or VA or honestly, any other type of loan. Closing costs for an FHA loan include a very specific thing, an upfront mortgage insurance premium.
Upfront mortgage insurance premium on an FHA essentially does two things. They do it as an upfront amount and they do it as a monthly amount. Okay? So upfront, they're going to collect a little bit of money and tack it onto your loan amount. If you refinance or sell your house in the first 3 years, a portion of that unused upfront mortgage insurance premium will come back to you in the form of a refund. On the monthly side, you're going to be paying your monthly mortgage insurance premium now for the full 30 years of your loan. So that means, are you going to be in your FHA loan for 30 years? Probably not. There's a good chance that this is a good way to get into a house, to get the ball rolling, And then in 3-4 years, you may look at refinancing out of your FHA into a conventional loan so you don't have to pay that mortgage insurance premium anymore.
It's also important to consider that if that upfront mortgage insurance premium feels a little hefty and you have the means with which to already qualify for a conventional loan, you're just trying to go FHA because maybe, I don't know, you like the lower down payment a little bit better. It's valuable that you ask your lender to compare and contrast the true costs of the loan between the FHA and the conventional loan. You may actually find that it's more valuable to go one way or the other. Now, every case is specific and every case is unique, but I'm just telling you, one key thing that most people forget about is that upfront mortgage insurance premium. And sometimes that could be the difference about why it's valuable to go with just a traditional conventional loan or stick with that FHA loan.
When it comes to income, FHA's income qualifications are very similar to most other standard programs. If you're W-2, it's pretty easy. If you're self-employed, same kind of rules. We're gonna have to see a 2-year self-employment history with your tax returns and a profit and loss statement showing how much money you're making, so we get a sense of, as a self-employed person, how much money you're actually making. So one of the things that we can think about when it comes to an FHA loan, which is applicable for every other loan out there. Essentially, I use the analogy of like a 4-leg table. There are essentially 4 pillars that we're looking at whether or not you're going to get money. Number 1 is going to be your debt to income ratio, which means your money coming in versus your money going out. Credit score and credit report. What's showing up on credit? What's your credit score? Are there any, catastrophic things that have occurred on credit that we got to deal with? Your down payment, loan to value, how much money you're putting down, and then how much money you got in the bank. Having money in the bank is different than how much money you're putting down. If you have $100,000 in the bank, but you're putting down $100,000 on your mortgage, at the end of this, you have $0 in your bank. We'd rather see you put down less money to have money in the bank. It makes you more of a stronger case for lending you money, because it means if something was to happen, you've got extra assets you can then survive off of if something catastrophic was to happen.
And when Brett says we really just mean that's what the lenders look at.
Yeah.
What they're honestly trying to measure is your ability to withstand chaos after you've closed on the loan. Your ability to show that you have extra funds in the bank after closing makes them feel really comfortable about loaning you this large sum to buy this house.
And ultimately, even by doing an FHA loan, one of the things I like to take account for is I never want to put a client in a situation where they're going to be struggling after we close. If that's what occurs, I haven't done my job right. It's super important that as we go through this process and we look at all right, we're going FHA, we get a real good sense of your income, and if we're getting where we can qualify, but at the end of the month, you're having a hard time making ends meet, we haven't done you any services. Right. I like to use the term, qualification is not as important as comfort. You may be qualified to buy a $600,000 house. If you're not comfortable with that payment, there's no way that I'm going to push you to buy a $600,000 house. I want you comfortable. Comfort is way more important. One of the things that you might see as you're looking on listings is you might see a listing that says FHA not allowed. That usually means that the house isn't going to pass an FHA appraisal. FHA tends to sometimes have stricter appraisal guidelines than a conventional loan. Is that always the case? No, it's going to be appraiser specific. But the things that they're looking for is they're looking for health and safety. Okay? Yeah. So that means if you're going into a house, and let's say the house was built back in 1967, and the paint is peeling off the walls. Well, guess what? There's a good chance that paint is lead paint, and that becomes a health and safety issue. So FHA is then going to require that house is repainted before you can close on it. If you go in there and there's a flight of stairs and there's no railing on the stairs, again, health and safety. You might fall off the stairs and break your leg. If you go in there and the carpet's ugly, they don't care. Ugly is different than health and safety. Ugly can be fixed. Old kitchen, don't care. As long as it's not on fire, you're going to be all right. But the safety requirement is a little bit different. So sometimes a house that says no FHA means that the listing agent has done due diligence and don't think it's going to pass an FHA appraisal. Right. Does that mean you can't do it? No. You can still make an offer. If an appraisal comes back, it might come back as to what's called subject to. Subject to means there's a list of conditions that have to be met before the FHA will allow you to do this loan. It might be as simple as painting a garage door, or fixing some peeling paint on a shed, or even I've seen them where they have to, they want you to put the coverings on outlets. Mm-hmm. It could be simple, or it can come back and say the back deck is structurally unsound and might fall off the house and kill somebody. that's the case, in order to close, those things have to be fixed before closing. So condition of the property sometimes can be an issue. It's important that, if you're looking at a house that you might have a question on, reach out and, we can use our knowledge and say, hey, that might be an issue. But ultimately, that's a call done by the appraisal.
Another reason that borrowers reach out to us, future homeowners reach out to us to try to leverage an FHA loan is for a concept called house hacking, where you buy a house and you rent some portion of that house out to help cover the mortgage. Now, while FHA loans in their own right do not allow house hacking, there's a multitude of ways that you can accomplish house hacking when you are trying to buy the home of your dreams.
It's super important that you don't self-diagnose that you don't qualify for a mortgage. Where people just don't think, I don't qualify, I'm not gonna be able to get a mortgage because I have student loans, because I have XYZ debt, because I don't make enough money. You'll be surprised the amount of people that we speak to that actually qualify.
Yep.
What we do is we'll look at your situation and we'll utilize the FHA to make sure that maybe you do have a plan of attack right now. And if not right now, what is it going to take? We put together the marching orders, and it might be 6 months, it might be a year, but that knowledge is power for you. Don't self-diagnose. FHA is a very, very flexible program, and if it's done right, chances are we can get you into something. On the market, you're going to find that as you're out there looking with your agent, there's going to be a lot of misconceptions about FHA. There's going to be a lot of sellers that are listing agents that are going to say, we don't want FHA loans because the appraisals are too hard or because blah, blah, blah. Let us handle that. FHA is dynamite. I can tell you that if I've got you approved FHA and we get an FHA contract, the pull-through ratio on that is usually about 95%, meaning that barring some catastrophic thing that we don't see up front, we are going to close your mortgage. If there's something that you don't tell us, like, I don't know, that you've got a secret family in Canada, that might be a problem, right? But usually if we get it approved FHA, we can get this thing all the way through. I like to tell listing agents that FHA is actually a better way to take an offer because there's more gray area to move through. Where if we find a stopping point in the maze of going through this process here, there's usually 2 escape routes going some other direction.
There's tons of flexibility for us to get you to the closing table and get the loan completed.
Don't self-diagnose, let us diagnose. This process is stupid and it's scary. And understand that you're not going to want to reach out. What we want to do is just help you. Set up an opportunity for you to own a house and start building wealth.
My first house that I bought, the home that I lived in for over 6 years, I used an FHA loan.
My house that I bought, FHA loan. They're dynamite programs.